Welcome to the next lesson. Personal accounting is the practice of organizing financial data to gain a clear view of your economic health. While budgeting focuses on planning your future spending, accounting focuses on recording what has already occurred. By treating your household or personal finances with the same rigor as a small business, you move from reactive survival to proactive management. This systematic approach ensures that every dollar is tracked and that your financial decisions are based on data rather than intuition. Organizing your financial accounts. The structure of your account determines how easily you can analyze your spending habits. Use a tiered system to categorize your money based on its function and liquidity. At the highest level, you should separate your operating capital from your reserves. Operating capital includes the checking accounts you use daily expenses for or monthly bills. Reserves include high yield savings account, emergency funds, and investment accounts. Categorizing transactions. Effective accounting requires consistent categorization. Instead of generic labels, group your expenses into buckets that reflect your life. Common categories include housing, transportation, health, and lifestyle. Within these, use subcategories to provide granular detail. For example, under transportation, you might track fuel, maintenance, and insurance separately. This level of detail allows you to identify exactly where your money is going if you need to reduce costs in the future. Separating personal and business funds. If you're an entrepreneur or a freelancer, the most critical accounting rule is total separation of your personal and business finances. Use different banks or entirely separate accounts for each. Mixing these funds obscure your true profitability and create significant complications during tax season. Pay yourself a set salary from your business account to your personal account to maintain a clear boundary between your personal revenue and your personal lifestyle. The general ledger approach. In professional accounting, a general ledger is the master record of all financial transactions. For personal use, this can be a digital spreadsheet or a specialized software tool. Every time money moves, it must be recorded. This includes not just cash outflows, but also credit card charges or automated transfers. Recording transactions. The goal is to capture and date the vendor, the amount, and the category for every transaction. Many people rely on their banking app to do this automatically, but automated tools often miscategorize spending. Reviewing and manually confirming these transactions forces you to confront your spending choices. This manual touchpoint is where the discipline of accounting truly resides. It prevents hidden spending, such as recurring subscriptions or small daily purchases, from accumulating unnoticed. Reconciliation. Reconciliation is the process of ensuring your records match your bank statements. At the end of every month, compare your personal ledger against your actual bank balance. If your spreadsheet says you have 2,000 but your bank says you have 1.8K, you have missed the transaction. Finding that 150 discrepancy is what builds financial integrity. It ensures that your data is 100% accurate, proving a reliable foundation for more advanced calculations like net worth tracking covered in the next lesson. Quarterly financial check-ins. Consistency is more important than intensity in a personal accounting. While daily or weekly tracking keeps the data fresh, a deep dive review every 90 days provides the perspective needed to make strategic adjustments. A quarterly check-in allows you to see patterns that are invisible in a week-to-week basis, such as personal spikes in utility bills or frequent impulse spending during stressful work months. Reviewing fixed and variable costs. During your 90-day review, separate your expenses into fixed and variable costs. Fixed costs are those that stay the same regardless of your behavior, such as rent or car payment. Variable costs change based on the choices such as dining out or shopping. If your total spending is higher than your targets, your variable costs are the first place to look for adjustments. Use the data from the past 3 months to set a realistic limit for the next quarter. Auditing subscription and reoccurring fees. The subscription economy often leads to a leakage, money leaving from your account for services you no longer use. Every 90 days, look at your bank statement specifically for reoccurring charges. Evaluate whether each subscription still provides value commensurate with its cost. Canceling a $15 monthly service that you don't use saves you $180 a year with zero impact on your quality of life. These small wins, when compounded across multiple categories, significantly increase your availability to capital. Maintaining financial discipline. Accounting is a habit, not a one-time event. The primary reason people fail to maintain their finances is that they allow the data to pile up until the tasks become overwhelming. To avoid that, integrate accounting into your routine. Make it normal. The weekly sweep. Spend 15 minutes every Sunday Reviewing the previous week's transactions. Categorize anything that is uncategorized and check your current balances against your 50-30-20 targets. This sweep ensures that by the time you reach your 90-day check-in, the data is already clean and organized. It transforms a potentially grueling multi-hour task into a series of manageable micro-tasks. Emotional neutrality. Approach your accounting with clinical objectivity. The numbers are simply data points. They are not a reflection of your worth or character. If you see that you overspent in a specific category, do not let guilt prevent you from recording it. The purpose of accounting is to provide the truth. You cannot manage what you do not measure, and you cannot measure what you are afraid to look at. By maintaining a neutral, disciplined approach to your records, you remove the emotional weight of money management and replace it with the clarity of a well-run business. Tools for effective record keeping. While a specific tool you use is less important than a habit of using it, your choice should reflect your technical comfort level. A simple spreadsheet is often the most powerful tool because it's fully customizable. You can build columns for specific goals, such as saving for a home or paying down specific debt. Digital versus analog. Digital tools offer the benefit of speed and accessibility. Apps can sync with your bank accounts and provide real-time updates. However, if you find that digital tools make it too easy to set it and forget it, consider a more manual approach. Writing down your expenses or manually entering them into a spreadsheet creates a psychological friction that can help you curb impulsive spending. The more you interact with your numbers, the more financial intuition you develop. Backup and security. Treat your financial records as sensitive data. If you use a spreadsheet, ensure it is password protected or backed up by a secure cloud service. If you use an app, enable a two-factor authentication. Your accounting records contain a complete map of your life and habits. Protecting this information is a fundamental part of capital management. Regular backups ensure that even if a device is lost or service is discontinued, your years of financial history remain intact, allowing you to track your progress over long term.